China's $500 billion energy surge, the 2025 investment that could reshape global power. In 2025, China quietly crossed a threshold that may prove more important than many geopolitical headlines. The country completed more than 3.5 trillion yuan in major energy project investments, roughly $502 billion at current exchange rates. That is not just a record. It represents a nearly 11% year-on-year increase, according to official data from China's National Energy Administration. But the real story is not the headline number. It is where the money is going, and what that means for global energy, climate politics, industrial competition, and the balance of economic power. Because this is not simply spending, it is strategic positioning. To understand the magnitude, $502 billion in a single year is larger than the GDP of many mid-sized economies. It exceeds the annual defense budgets of most countries, and it comes on top of already massive energy investments made by China over the past decade. This is part of a long-term structural shift, not a one-off stimulus program. The 11% growth rate is also significant. At this scale, double-digit expansion implies sustained policy commitment, especially when global investment in renewables has been uneven in recent years due to higher interest rates and supply chain pressures. The breakdown of investment is even more revealing. Onshore wind power investment rose nearly 50% year-on-year. Investment in new types of energy storage and hydrogen energy projects doubled compared to 2024. Those are not marginal increases. They represent acceleration. A near 50% increase in onshore wind investment suggests China is doubling down on technologies it already leads globally. China is already the world's largest manufacturer of wind turbines and solar panels. Expanding domestic deployment does two things. It strengthens internal energy security. It deepens economies of scale, lowering global costs and reinforcing export dominance. Lower costs make Chinese renewable equipment even more competitive abroad, especially in emerging markets across Asia, Africa, and Latin America. Renewable energy only works at scale if electricity can be stored. New types of energy storage typically refers to advanced battery systems, pumped hydro storage, compressed air systems, and grid-scale lithium battery projects. The doubling of storage investment is critical. It suggests China is not just building generation capacity, it is addressing intermittency, the Achilles heel of wind and solar. If storage costs continue falling while capacity expands, China could solve one of the biggest technical barriers to renewable dominance. That would give it leverage not only in manufacturing, but in grid technology exports. Hydrogen energy remains experimental in many countries. China is betting that it will become a core component of heavy industry decarbonization, particularly steel, chemicals, and long-haul transport. Doubling hydrogen investment signals strategic patience. Hydrogen may not yield immediate returns, but if China captures leadership in electrolyzers, fuel cells, and hydrogen logistics, it could dominate the next wave of industrial decarbonization technologies. Another striking data point. Investment by private enterprises in key energy projects increased 12.9% year-on-year, about 2 percentage points higher than the national average. This matters. It suggests China's green transition is not purely state-driven. Private capital is participating, and even outperforming the national growth rate. That implies increasing commercial viability of renewables, market confidence in long-term policy direction, a shift from subsidy-driven growth to profitability-driven expansion. In geopolitical terms, this makes China's energy transition more durable. State-led projects can stall under fiscal pressure. Private capital participation reduces that risk. This story is not just about climate, it is about power. 1. Energy security. China remains heavily dependent on imported oil and gas. Expanding domestic renewable generation reduces exposure to maritime choke points like the Strait of Malacca. It strengthens strategic autonomy. 2. Industrial competition. The global clean energy supply chain is already deeply China-centered. If investment continues at this scale, battery supply chains, wind turbine manufacturing, hydrogen equipment, grid-scale storage systems may become even more concentrated. This raises questions for Europe and the United States, both of which are attempting to localize green supply chains through industrial policy. China's scale advantage may prove difficult to counter. China is the world's largest carbon emitter in absolute terms, but it is also the world's largest renewable investor. That duality shapes global climate negotiations. By expanding clean capacity at record levels, Beijing can argue it is leading the transition, even as coal use remains significant. This creates diplomatic leverage in forums like COP negotiations and Global South climate financing discussions. China's broader economy has faced challenges in recent years: property sector stress, local government debt, and weaker consumer demand. Energy investment provides industrial demand, employment creation, regional development, and technology upgrading. Green infrastructure functions as both climate policy and economic stimulus. But unlike property construction, it builds productive assets tied to future competitiveness. However, this trajectory is not without risk. Grid integration challenges remain. Renewable curtailment, when electricity cannot be transmitted efficiently, has been a persistent issue in some regions. Local government financing models face pressure, and overcapacity in manufacturing could trigger trade tensions. Already, Western governments have expressed concerns about clean tech, overproduction, and dumping risks. If export markets close due to tariffs, domestic overcapacity could strain margins. The transition must balance scale with sustainable profitability. According to Xing Yiteng of the National Energy Administration, policy support will intensify in 2026. The focus will be boosting market vitality, improving the development environment, removing project bottlenecks. That language signals regulatory refinement rather than slowdown. If investment growth continues at double-digit rates, China could enter the 2030s with the world's most expansive renewable grid, deep dominance in storage technology, a head start in hydrogen commercialization. The global energy transition is often framed as a moral imperative, but in practice, it is an industrial revolution. And revolutions create winners. In the 19th century, industrialization reshaped global power. In the 20th century, oil defined geopolitics. In the 21st century, the question may be, who controls the infrastructure of decarbonization? China's 3.5 trillion yuan investment in 2025 suggests it intends to be at the center of that answer. The scale is unprecedented, the speed is accelerating, and the strategic implications extend far beyond energy.